It's 9:29 a.m. on a Monday. Traders are at their desk. Coffee's getting cold. Algorithms are warmed up, ready to fire 10,000 trades a second. The opening bell is 1 minute away. It never rings. Not because of a crash. Not because of a holiday. Because as of today, the stock market doesn't exist anymore. Not paused. Not temporarily halted for volatility. Gone. Forever. No New York Stock Exchange. No NASDAQ. No London, Tokyo, Shanghai. Every exchange on earth closed permanently starting right now. You have $40,000 sitting in an index fund. Your parents have their retirement in a 401k. Your company's stock options were supposed to be your down payment. What happens to all of it? Stick around, because the answer isn't. You lose your money. The real answer is much stranger, and it says something about what money actually is that most people never stop to think about. Let's set the rules of this experiment because they matter. The companies still exist. Apple still makes iPhone. Amazon still ships packages. The buildings, the factories, the employees, none of that disappears. What disappears is the market, the mechanism that lets you trade a piece of ownership in those companies for cash, instantly, at an agreed price. So on Monday morning, here's what actually happens, hour by hour. 9:30 a.m. Every brokerage app in the world shows the same thing, a frozen number. Your portfolio still says $40,000, but that number is now a fossil. It's the last price anyone agreed to pay, not the price anyone will pay, because there's no longer a place to make that agreement. 10:15 a.m. Financial news anchors are on air with nothing to report. No green, no red, just static account values. One anchor says something almost philosophical without meaning to. For the first time in history, nobody in the world knows what any company is worth. That line is the whole video, by the way. Sit with it for a second, we'll come back to it. 11 a.m. Panic sets in, not because people lost money, but because they've lost the ability to know if they lost money. That uncertainty turns out to be worse than a crash. A crash is bad news you can price in. This is no news at all. Forever. 1 p.m. The first real casualties show up. Margin account. People who borrowed money using stocks as collateral. Their lenders don't know what the collateral is worth anymore. So lenders do what lenders always do when they're scared. They demand cash. Immediately. Regardless of what the market situation is. Except there's no market to sell into to get that cash. By the end of day one, we haven't seen a single stock trade. And that silence is already reshaping the entire economy. Here's where it gets uncomfortable. Because the pain doesn't land where you'd expect. The people who get hurt least. Long-term holders who weren't planning to sell anytime soon. If you own Apple stock and you weren't touching it for 20 years anyway, congratulations, you still own a piece of a company that sells $1 billion of iPhones a day. The company didn't stop working just because the price ticker did. The people who get destroyed almost immediately. Anyone whose life depended on liquidity. Retirees who plan to sell 4% of their portfolio every year to live on. Companies that pay employees partly in stock, expecting them to sell shares for rent money. Pension funds that owe monthly checks to 11 million retired teachers and firefighters, calculated using a market value that no longer updates. Let's make this concrete. A pension fund in Ohio owes $2.3 billion in payouts this year. Half of that was supposed to come from selling appreciated stock. That stock still technically exists. It's just frozen in place, like a photograph of a fire. You can see the flame, you just can't feel any heat from. So the fund does the only thing left. It starts negotiating private sales. A buyer with cash offers 60 cents on the dollar for shares nobody can independently price. The fund has no leverage. It takes the deal. And this is the first real discovery of the experiment. Markets don't just set prices. They set trust. The moment there's no public, competitive place to trade something, price becomes whatever the most desperate seller will accept from the least desperate buyer. Within 2 weeks, we don't get no prices. We get private, invisible, wildly unequal prices. A black market for ownership, run by whoever has the most cash and the least urgency. Humans have never gone more than a few years without inventing some version of a stock market. Going back to 17th century Amsterdam. Shut the official one down, and people don't stop trading ownership. They just stop doing it in public. Within a month, 3 things happen simultaneously. 1. The rise of gray exchanges. Groups of large investors, hedge funds, and even ordinary people start forming private trading clubs, essentially rebuilding a stock exchange with none of the regulation. Prices there are wildly volatile because there's no transparency, no rules against insider trading, no requirement that a company report honest numbers. It's the Wild West, except the guns are spreadsheets. 2. Companies stop being public in any meaningful sense. Without a market, being a public company loses its purpose. So large companies start doing something radical, buying themselves back from their own shareholders using cash reserve, effectively going private. Employees get paid in salary and bonuses instead of stock. The entire idea of owning a piece of Amazon as a normal person starts to fade, because there's no functioning system left to make that ownership liquid. 3. Capital flees to anything that still has a working price. Real estate, gold, farmland, fine art, even collectible. Anything with an active, working market for buying and selling suddenly becomes wildly overpriced, because it's now competing to absorb all the capital that used to live in stock. Housing, which was already unaffordable in most major cities, gets meaningfully worse within a single year, because a stock market crash you can wait out. A stock market that no longer exists, you can't. Which brings us to something almost nobody expects going into this experiment. Shutting down the stock market doesn't stop people from investing. It doesn't even really slow it down. It just moves all of that money into markets with worse rules, worse transparency, and worse protection for ordinary people. The public stock market, whatever its flaws, was doing a job nobody notices until it's gone, giving millions of regular people the same price, at the same time, with the same information, as a billion-dollar hedge fund. Take that away, and the money doesn't disappear. It just goes back to only being accessible if you already know somebody. Fast forward 1 year. Let's check the state of the world. Unemployment hasn't spiked dramatically. Companies are still running, still selling things, still paying people. But something quieter has shifted. Capital formation has nearly stopped. Here's what that means in plain terms. A stock market isn't really really about existing companies trading hands. It's about new companies getting funded. A startup with a good idea used to have a path: raise money privately, grow, eventually go public, and use that public capital to expand, hire, build factory. That entire ladder just lost its top rung. So venture investors get more cautious because their exit, selling shares to the public eventually, no longer exists. Fewer startups get funded. Fewer new companies are born. The economy doesn't crash, but its future got noticeably smaller. Growth doesn't stop. It just slows to something closer to how economies grew before modern stock markets existed. Centuries of much slower, much more unequal capital accumulation, controlled by whoever already had money. Meanwhile, the gray exchanges have basically reinvented the New York Stock Exchange from scratch, just without any of the guardrail. History suggests this is exactly what would happen, because every time formal markets have been suppressed, informal ones have appeared within months, from Prohibition-era speakeasies to underground currency markets in countries with capital controls today. So a year later, the world hasn't rejected market. It's just rebuilt a worse version of the one it destroyed, minus the rules that protected the smallest players in the room. Here's the part of the experiment that reframes everything. We started this video assuming the stock market's job is to tell you a number, your net worth, your portfolio value, whether you're up or down today. But that number was never the actual product. The actual product was trust at scale. A stranger in Ohio and a stranger in Singapore, who will never meet, agreeing on a price for something neither of them can touch, using rules either of them wrote, enforced by either of them personally, and both trusting it enough to put their retirement into it. Shut that mechanism down, and money doesn't vanish. Wealth doesn't vanish. What vanishes is the shared agreement that let millions of strangers price things together fairly in public at the same time. And once that shared agreement is gone, it doesn't come back as something better. It comes back as something smaller, more private, and more tilted toward whoever already had the most. That's the real finding of this experiment. The stock market isn't a casino you can walk away from without consequence. It's closer to a language, and the moment enough people stop speaking it in public, the ones with the least power are the first ones who go quiet. So, Monday morning, the bell doesn't ring. Somewhere, a pension fund manager is on the phone, trying to sell shares nobody can price. Somewhere else, 3 guys in a private chat are quietly building the next stock exchange, except this one only lets in people they already trust. The number on your screen is frozen, but the world underneath it never stopped moving. If this experiment made you think differently about what a share price actually represents, that's the whole point of this channel. Every week, I break the economy on purpose, just to see what's actually holding it together. Subscribe if you want to run the next experiment with me, and tell me in the comment, if the market shut down tomorrow, what's the first thing you try to sell?